All right. Well, hello everyone. I'm Nicholas. I'm a PhD student and part of the SDC scholarship, so the Sino-Danish Center, which was presented yesterday. And what I'll be presenting today is a comparative approach to industrial consumers' electricity market participation options. And I'll illustrate that with a case study of an industrial cooling process in Denmark, because yes, even in Denmark we have need for cooling once in a while. So what do we mean by demand-side participation in electricity markets? Well, first of all, to give a bit of context, Denmark is a typical example of a deregulated market where essentially the overall operation of the electricity system is assured by splitting up the responsibilities between different actors, spanning from the generation side through the transmission actors all the way to the consumer. To ensure this operation of the system, there's different markets essentially which have different functionalities. Some are more for day ahead scheduling of your bids. Some are more for short-term adjustments, and we've seen an example in the last presentation. Why not local markets as well? The problem is, until now, most of these markets have been planned from a generation side perspective, as they were the main dispatchable part of the system. With the increase in variable renewable energies, however, this dispatchability on the supply side is reducing. And so that's where we need to engage the consumers. And that's where these markets, which really before were more like services, really become markets because there's an exchange coming with information from both sides. Now, the question is, so this is what we call market-driven demand response. Now, the question is, as a consumer, which market should you participate in and bid your flexibility, which was mentioned in the opening speech? Should it be in this one, in this market, the short-term market, etc.? So it really depends essentially on the consumer. And so in this talk, we're focusing on industrial consumers who have been shown to have potential to bid in markets or to have flexibility. However, there's still a hesitance to participate in these markets. And there's different factors for these. There's external factors, of course, and maybe the market price dynamics are not attractive enough, or the market regulations don't allow them to participate in the markets. But there's also a series of internal factors, and that's really dependent on the industrial consumer's decision to participate or not. And a large part of the unwillingness comes from the operational risk, which comes from shifting your process schedule. And then this risk doesn't necessarily balance out with the financial returns, which remain uncertain. And that's because it's difficult for someone to know whether its specific process is suited for a market. So is my market suited for market participation? Is my process suited for a specific market? And so to answer this question, there's been a lot of algorithms and market bidding strategies proposed in the literature with optimization methods, etc. But the question is, if you have several markets, why bid in this one? Could it be this one, or why not bid in this one or another one? So essentially, the idea is when you have a range of submarkets possible and a range of flexibility levels or amounts of flexibility, your first level, let's say, or amount of flexibility could be suited for this market, and then why not another combination for level 2, and so on and so forth. So that brings us to our research question: how, if at all, does available process flexibility impact the choice of market participation? And I'll come back to what I mean by market participation option in the next slides. But to answer this question, we'll first on one side characterize what we mean by flexibility. Then on the other, we'll define the different market options available. And then we'll implement a bidding logic for each of these market options, and then test essentially how the different flexibility scenarios behave in each market option. So in terms of process flexibility, and I think I'd like to acknowledge the work done by Torben and his colleagues in this context, because you'll recognize this kind of two-dimensional division of flexibility into load-based, so essentially within a power range. You increase this power range, you increase your flexibility, and then this time-based flexibility. So for short time-based flexibility, you have a certain time interval to ensure that your flexible load matches your initial unflexible load. And then you can increase this time shift, meaning you can increase essentially the time over which you can bid. So you have a higher likelihood of having larger price differences. So you can create more benefits on the market. So those are the two dimensions of flexibility we're using in the study. And then on the market side, so as I mentioned, we have different options. In this case, we're using 3 different submarkets. So the day ahead market, and then downstream markets are the intraday and regulating market, where essentially you can adjust bids you did in the day ahead market. And in this context, this provides the opportunity to create some savings or revenues from market participation. Because essentially, if you look at the graph below, if you have initially your unflexible volumes as VAU1 and VAU2, what you could do essentially is, if prices are relatively cheap in the day ahead market, you could overbid within, of course, your physical allowed constraints. And then within the intraday market, you can then sell your extra volume at a beneficial price difference, and therefore create savings. And that's what I call intermarket price variability. So you use the advantage of price differences between markets. And then, of course, there's also the fact that you can use the price differences between hours within the same market. And that's what I call intra-market price variability. So you can decide to shift your process. And so the question now is, how does flexibility, or the amount of flexibility you have, allow to make use of these different price variabilities? And so to test that, we have these 6 different options. Some of them are single market options, and some of them are multiple market options where you bid into several markets flexibly. The option 4 being essentially what I explained in the previous slide, with the interaction between the day ahead and the intraday market. And once you have these options, you must have a bidding logic to decide how to bid at each hour in each market. And for that, we implement a relatively straightforward linear optimization program, where the idea is to know essentially for each X at each hour and each market, how much should I bid? So for this problem, there's market constraints, such as in the regulating market, you can only bid negative volumes for upregulation, or positive volumes for downregulation. But that's not really the interesting part. What we'll focus on is, or vary in the different scenarios, are the flexibility constraints of the process. And so essentially, this is the energy balance. Your flexible load must equal your unflexible load. And what will change here is the time shift over which this balance has to occur. So that's the time-based flexibility. And then on the other hand, on the other side, will also vary the load-based flexibility, so the interval over which your load can vary. And so if you solve this for every day in each market option, you get a result like this. That's an example if you bid in all 3 markets of an optimal bidding schedule. And it's important to remember that for this case, or for this general study, we've assumed that we have a perfect price forecast. And I'll come back to that in the discussion section on what this implies. But now let's move on to our case study. So the actual process is a meat cooling process in a factory. And your flexibility comes from the fact that you can change your temperature limits, essentially, from a lower limit and an upper limit. And the meat stays in a certain room for a certain time until it moves to the next room. So that's your time shift interval. And so these temperature limits and the time shift varies depending on the room in which the meat is being processed. So these temperature requirements vary depending on different process steps. And they could also vary depending on the product specifications. So the end customer you're supplying this meat to. And so we're going to test these different flexibility scenarios in a market context in June 2020. And as you can see on the right here, you have intermarket price variability within the hour, so between markets, and also intra-market variability, so within the same market, but different hours, different prices. So that's all opportunities essentially to generate some savings. So as I said, so there's going to be 3 scenarios. The first one is time-based. And so essentially what we're going to do is increase progressively our time shift interval and see how that affects savings. And scenario 2, we're going to increase temperature limit, so decrease power limit, to see how increased load range affects your savings. And in the third scenario, we're going to increase on both sides, essentially the lower and the upper limit. Also load range flexibility, but implemented in a different way. And we'll see how that changes your savings differently, impacts your savings. So if we come to the results now, this is scenario 1. I think on the left, one clear result is that multiple market bidding seem to actually yield a lot more savings than your single market options, which are here on the bottom. So sorry, the y-axis is your daily electricity bill. So the higher this value means the lower your bill, so the more the savings you've done. And it seems that choosing the right market option is more important than the amount of flexibility you have, because really you can save a lot more in this case. And I want to focus on this first hour, essentially, where most of the savings are done. And that implies that it's done through intermarket price variability, right? So within the hour, you can do this trade between markets. And then if you increase your time shift capability, you have you can use this this variation of market prices over different hours. That's the intra-market price variability. And we see that different options react differently to this this price variability. But before we focus too much on these absolute values, which are very specific to June 2020, I want to focus a bit more on what's happening on the right. And essentially, that's kind of the same information, but kind of scaled for each market individually, from min to max saving. And what we see is this kind of saturation effect. Most of the savings are done in the, or increase in savings are done in the first few hours. And what this means is that essentially your price variability over a 24 time interval is not that much bigger than over a 12-hour interval. So there's not much gain in savings to be expected in that case. While for multiple market options, most of the gains are already done at very low flexibility. So there's even less incentive to have higher flexibility in this case. So now if you look at load-based flexibility, the full lines represent scenario 2, where we essentially increase temperature only in one direction, so decrease power in one direction. And actually, surprisingly, we have limited extra savings. You could think, if I have a higher load range, then I can bid more in the market and make more savings. The problem is, in this case, you're faced with physical constraints. So this is what you would intuitively think you could do, but in reality, you have this energy constraint, right? Whatever you bid up has to be matched by a bid down to make sure that in the end you consume the same amount of energy. So in this case, we see the saturation effect due to operational requirements, and this is what the full line shows here again. On the other side, if you increase your increase and decrease your power limits equally, then you can really do this overcompensation and then balance that up by an undercompensation. And that's why savings kind of increase more linearly, essentially, as you increase your load range, and it would increase further if you increased it onwards. So this is all well, but you'll tell me, why do you compare these different markets if it seems that the multiple market options always seems to generate most savings? Well, as I said, an important assumption we took is that we assumed perfect price forecast, and that essentially eliminates the aspect of risk. In reality, the thing is, each market has a clearing probability, right? Because you're uncertain whether your bid will get cleared or not. And the more markets you participate in, the higher this risk, or the higher the chance of not getting cleared. So essentially what should be done is to, and hasn't been done in this study, but is going to be essentially should be further work, is to define a risk threshold for each kind of market option. And essentially you would only participate in that market if the savings are above this specific risk threshold. So you could define a different one for each market depending on the risk involved in participating in that market. And it could then turn out that essentially in this first flexibility range, you would prefer the day ahead and intraday market. And in the higher flexibility range, you would prefer the day ahead and regulating market. But of course, so this, as I said, requires to quantify your risk with a probability of clearing failure times the consequence of a failure. But those are behavior dependent, and that's a large reason why we haven't included it in this quantitative approach in this study. So that's obviously going to be further work. What happens when your bid loads are not equal to your cleared loads in terms of operational loss and in terms of imbalanced payments? So how does that impact the risk threshold for each market option? And then further work should also be that for now, we've assumed that all market prices in each market are known at the same time. In reality, because they're sequential markets, you only know the price of, you don't know the price of future markets when you bid in the first one. So this is the reality. So it would imply much less risk-taking bidding. And so multiple markets could generate less savings than expected. So to round this off, I think a first point I want to bring home is that market option choice can impact, so the right choice of market option can impact savings more than the actual level of flexibility you have. However, flexibility impacts savings in different ways. So the amount of flexibility, of course, but also the type of flexibility. So we've seen that different scenarios react differently to increases in flexibility. And very importantly is the fact that having available flexibility is good, but if there's no overlap with favorable market prices, then your savings will be relatively minor. And that's kind of what I try to illustrate on the right here. So if you increase your flexibility, you increase your savings potential, right, in this black area, and you can increase it further. But after a certain point, there's no point in increasing your available flexibility even further. And that's kind of the saturation point, which we saw on the curves, kind of doing this flattening out after some point. Finally, the final market choice depends, of course, on this balance between savings and the participation risk. And that's going to have to be, further work essentially to quantify risk as well, to do this option appropriately. That was it for me. And feel free to ask me questions if you have any.